Hi there, I'm Justin Reid. I'm the CEO of Troilus Gold. We are a $120 million developer building and moving forward the Troilus gold mine in northern Quebec. 8.1 million ounce resource and growing. Large institutional shareholders and a great balance sheet.
Good to see you again, Justin, and good to catch up, and particularly timely. We are getting a lot of inbounds from CEOs, a little bit nervous about how to present information in the marketplace. They're seeing their economic studies crumble before their eyes, inflationary pressure. One today gone from 80% IRR down to 23 overnight because of, I think it was a 150 million increase in their CapEx. Pretty scary times to be doing business, Justin.
It's the world we live in, right? It's a high risk game. Mining is, but it's a necessary. So what you have to do is make better projects, and you have to put contingencies in place. And you have to make sure you do your work right.
You do have to do your work right. Well, yeah. But it's like you do have to do your work right, because you can't disappoint the market by coming out with a very different set of results. As the company this morning I was talking to found out, much to their shareholders' dismay. But look, I want to talk to you about some of the news that's come out recently. I guess let's kick off with the first bit of news. But where I want to go with this conversation, where I think your shareholders and investors alike who've been sort of sitting on the sidelines waiting to see what's going to happen, want to go is about how do you handle and navigate a market like this. But why don't we kick off with the sale to Sayona mining? Why did you do it?
Capital, obviously, but it was the single most accretive deal that we could have done for any of our shareholders. Full stop. Over the last 4.5 years, we have acquired about a 1,400 square kilometer land position. As we added more ounces at Troilus and we built out the model, we understood how underexplored the belt was, and we built out this portfolio, and that's what it was. Over the last 4 years, we have probably spent about $25 to $30 million on regional exploration, including $7 million this year. All of the targets that I've been talking about to our shareholders and to the market over the last 3 years, we have retained. So basically what we've done is the first pass on this big land position. We've identified the key gold and copper properties that we want to keep, which include Testard and Palador and Crescidia. 400 square kilometers to boot, which is a huge ground package on the main trend. And then the other ground was essentially non-core, still prospective, but non-core. And we couldn't afford, for one thing, to spend $10 to $12 million a year on regional exploration, having a portfolio the size of most majors. For the last 10 months, we've been working very closely with Sayona Lithium, a $3 billion Australian developer or a producer in 100 days. At the end of our road, or the beginning of theirs, is their Moblin deposit, which is a spectacular spodumene, very intrusive that they're aggressively advancing. And they needed additional ground. They saw opportunity for exploration, which wasn't core to us. And, we cut a $50 million deal. And so it was two parts. It was a private placement, which collectively was done at about a 35% premium to market. They're now our largest shareholder at 9.3%, the same size as their partners Investment Quebec, by the way. And then we sold the ground for $40 million in Sayona stock. Just so everybody knows, Sayona trades about $90 million a day on the ASX. So it is liquid. It is like stock. We are not sellers today. Certainly we're huge supporters of them, but it provides that liquidity should we need it moving forward. And, now we have a balance sheet that's $65 million off of $120 million market cap company. We are in unbelievable shape for the next 3 years.
You are. I get it. $65 million that gives you optionality. But I want to talk about the trade-offs in terms of the decision making, because it's kind of like politics, right? Some people are going to like what you did, and some people are not going to like what you did. But what they do need to do is understand the rationale behind it. So yours was a case of, well, we didn't pay much for it in the first place. We picked up a bunch of cash now that gives us an opportunity to move the rest of the project along, and we've retained a big chunk of this land package to boot. So as far as you're concerned, that was the best possible decision, non-dilutory, etc. Is that what you're going with?
We've had very limited criticism of this deal. In this market, we're not revenue generators. We're capital spenders right now. And from our perspective, to sell non-core assets that we were not going to work on, and bring capital in so that our shareholders do not have to be diluted. We're not a major company. We are focusing on the development of the Troilus operation. We have some great exploration peripheral to it, which we will continue with, but our biggest shareholders, our top 20, do not want to hear that I'm spending $10 to $12 million flying airborne surveys 1,000 kilometers away from our mine. And so from that standpoint, it was about allocation of capital and prudent use of capital.
Right. Okay.
And I have a very strong feeling that if we want to get that ground back at certain times, we'll be able to go get it. We're working very closely with Sayona.
Fine. So I want to talk about the other levers available to you, though, because as I said at the outset, these are choppy markets. Sentiment is everything at the moment, and you've got to manage the way that you kind of navigate and tell that narrative, because most companies are saying the same thing and getting the same outcome. Their shares are being knocked hot and heavy. I get that gold is down. There's downward pressure there, and costs are rising through inflation, so upward pressure there, and everyone's being squeezed. So how do you take a low-grade project like yours and move this thing forward in a way which is going to be economic for you going forward? What are the levers available?
Ultimately, when you look at low-grade deposits that are built, being the optimum phrase there, they're ATMs. Once that capital is sunk, a 1 gram, a 0.7 gram ore body, Boddington at Newmont for the last 25 years at 0.5 is an unbelievable source of cash. Malartic, Detour. We've talked about those before. So the focus and the most important thing is getting built and not blowing up your cap structure and not blowing up the economics of the deposit. And how do you do that? We're in an inflationary environment right now. The $350 million CapEx of 2 years is 650 today. And that's well known. And we've seen 1,000 examples of that. So it's great. And Troilus, even before our new discoveries, which I'll kind of lay out for you here, we already had 3 to 4 to 5 years at circa a gram, higher grade than the cutoff grade material, obviously, into the mine plan. So you expedite your payback, right? You put the best ore through early, you pay back your capital. But as inflation runs away with you, that has to get better and better and better. So over the decision we made to go straight to the feasibility study was predicated on the discovery, or identification of 2 brand new zones, X22 and the connector zone. And these are both right at the main deposits. They are at surface, so readily accessible and significantly higher grade. At the connector zone, I won't go through, they're all in the press releases, but we had 46 meters of 4.4%. We had 101 meters of 1.3 grams. And you can go read 22 meters of 3. And this X22 zone is right off of the main deposit. The road between the two pits actually it comes to surface, and we've drilled it off over a 300 meter strike length. We are now extending it over 1 kilometer. So the impact is very simple. First 2 or 3 years, you put 1.2, 1.3, 1.5 or higher through the mill rather than 1. That's 50% more revenue if you think of it that way. It's shallow, easily accessible. There's not a lot of stripping. That means development to get there is lower. And all the work we were doing on the pre-feasibility was good. The way I described it to our major shareholders, I talked to them all, was, we're right down the middle of the fairway, just like everybody else is right now. But this is going to take a good deposit to make it great. and hopefully deflate that inflation, or at least accommodate for it. So yeah, we're really excited. The impact is going to be huge. The balance sheet is strong. Everything is lined up for us. Troilus right now today is in better shape than we've ever been in.
Right. So I want to be clear. So have you chosen to put out the feasibility study or not?
We were moving right from the pre-feasibility. We didn't put it out. We were finishing it. We're working on, putting some of the final pieces together and wait for some of the final engineering. And then we quickly realized and modeled the impact of what these two zones could be.
Right. But why can't you just say, I need to include those two zones in the PFS? Some people looking at this going, well, hang on a sec, there must be something.
Well, fair question, but that's timeline, right? So we need to drill these out for 30,000 meters. That's 4 to 5 months of additional work and probably $5 million more of money. So we can do that, and we can put our pre-feasibility out at the middle of next year, and that's just pushed everything out a year. And the pre-feasibility work today is incorrect because it doesn't include these zones. So we already know our metallurgical, our geotech, and our tailings work is done at a feasibility level. So let's just go straight to feasibility. Let's save 3 months on our ultimate timeline. This is accretive to time when you think about ultimate production. And let's save $5 to $6 million. And really include these high-grade discoveries, which are going to add ounces. Troilus doesn't need more ounces. Our new resource, when it comes out, will be a lot more ounces. We need better
that's my point
ounces.
Here. You don't need more. What are you saying? 8.1, maybe moving towards 10. It's like you don't need more ounces. You need higher grade ounces. But sorry, I need to stick with this PFS.
Higher grade ounces here early. Yeah.
Right. Okay. Well, that kind of is the point. Where I want to go is like, just I want to finish this off and kind of put it to bed and go, right, we don't need to talk about that again. And so the PFS, there's nothing being covered up here. It's just a case of, we'll take the stuff we've done on the PFS, we'll put it straight into the feasibility study, and we will obviously now include these two zones in the feasibility study of higher grade, and that gets us perhaps over this hurdle that some companies are struggling with at the moment, which is marginal projects, are being hit hard by this kind of upward and downward pressure that I mentioned earlier. You're saying nothing to hide. It's just like, let's save $5 million and get there quicker. That's all there is to it.
Yeah, and let's not put out something that's wrong. If you put out something that doesn't include this high grade work that we're drilling right now, it's wrong. It's irrelevant.
Well, it's not wrong. It doesn't suit you because the margins just got squeezed by lower gold price and higher costs. Your project would have looked a certain way without these, and it's going to look better with these. So I can understand that. So I don't think it's wrong.
It's going to look a lot better. Yeah,
it'll look a lot better. Okay, so let's talk about some of these other. So will you? I'm assuming you will also continue to go with regional exploration, or do you think now it's time to get honed in on this feasibility study just with the two zones and everything else is irrelevant?
We are finishing up our regional drilling right now. So we've drilled at Testard, we've drilled at Palador, and all the drills are back at the Troilus mine site. We'll be drilling through December 19th. That's when the camp shuts down for Christmas, and we'll fire back up on January 10th with 3 to 4 drills.
On what? On where?
X22 and the connector.
Okay, just those two zones, right? Because you talk about saving $5 million, right? I want to understand what else are you doing to reduce costs and get honed in on just higher grade for this feasibility study. So
the regional work's all done. Everything's focused on very specific drilling. Remember, for the resource which will come out later, 5 drills, 150,000 meters of drilling, and a lot of it was infill. 75% was infill, 25 was expansion, and now this is going to be all expansion drilling. And we'll be drilling it off at spacing phase 1 to inferred, phase 2 to reserve, and that'll go into the feasibility study, and that's in the back half of next year.
Right, and what, again, come back to the levers available to you. What else do you think you need to do to stop behaving like, talking like, and getting the outcomes of a lot of the companies who are, seeing their shares crushed? You've seen a spike, I don't know what that is, significant uplift in the last 3 weeks because of some of this change of attitude of yours, change of strategy of yours. Have you got more in the back pocket?
Yeah, we've got, we're, in the last month and a half for Troilus, we've made 2 announcements on 2 incredibly significant high grade zones. Highest grades ever drilled at Troilus, largest intersections, shallow, and we are spending so much time talking to our shareholders about them because everybody says this is what they were waiting for. And then this week we said, oh, by the way, unlike everybody else who is waiting for the window of equity financings to open so they can all run through the window as fast as they can and dilute everybody down, we just put essentially non-dilutive financing, 3 years of runway in the bank for our team and for our shareholders. And we can pretty much weather any storm here and move forward aggressively and to plan. You don't have to force anything through to get news to the market because you have to raise money. We can deliver the project without a lot of stress.
True. And I guess people will be looking to you and saying, well, what do you do with $65 million? I mean, how much does a feasibility study, will it cost you to get to the end of the feasibility study?
Probably about $15 million with drilling.
Okay.
Well, there's a lot of drilling, right? Drilling's expensive. $200 a meter.
Right. But
plus sampling, plus met work. So yeah, we're in great shape, and we have a reserve that we won't blow. So
actually, it's a funny one. Actually, someone asked the other day, what do people talk about resource and reserve? It just talks to the importance of a reserve, just for those perhaps people coming in new to this.
I mean, I put out. I think for a lot of our retail shareholders, if I put out an inferred versus a reserve, they don't really understand what that means.
Exactly. Yeah.
An inferred is done to a certain spacing, to a certain level of certainty. For me to put a feasibility out, I need a reserve, which means that it has been drilled at an accepted spacing, and the probability or the level of accuracy is significantly higher. So if I was to put out a 1 million ounce inferred resource on, call it 10,000 meters of drilling, I would need another 20 to 30,000 meters of drilling on top of that exact footprint to bring it to a level of certainty for the feasibility. And I think that's what a lot of people miss. Is like, when you have 1 million ounces, you have 1 million ounces. No, you don't. You have 1 million ounces that I'm going to drill for the next 3 years to get to a reserve readiness. So we have drilled between 250 and 275,000 meters at Troilus. We're going to drill another 30 to 40,000 here, and that's in 4 years. And ultimately, things we don't talk about, condemnation drilling. I have to drill everywhere we want to put a site, a waste pile, what have you, to make sure there's no gold there. I'm drilling for no gold to make sure I can put my foundations there. I need to do geotech drilling, which is I'm going to drill all around the pits at different angles and look at how the stability of the rock is so we can calculate the pit slopes. There is another 20%, 25% of drilling that isn't even discussed, and that's all additional costs. So there is a lot more to it than just drilling out 1 million ounces. You then have to define them and engineer them. And that's kind of on a dollar value times 3. So
okay, so we've kind of had a slight indication from you as to what the higher grade stuff could do. Some back up the envelope type stuff from you. It's going to be critical in an environment like we're seeing at the moment. Bit of M&A happening, obviously. Yamana deal, yeah, been a lot of fun watching that one. But also in terms of consolidation in where you operate, okay, the province in which you operate. I mean, it's going to affect Yamana deal is going to affect some companies in terms of their strategy and what they were hoping might happen, and in terms of the optionality of or even competitive tension as to how things may operate there. You've got how do we fill some of those mills which are underutilized? Whose balance sheets do we use? What picture are you trying to paint, and for whom? No one wants to build a mine. You don't want to build a mine. What's the plan?
I mean, we have the team to build the mine, and we have the resources to build the mine, and we are building a mine until somebody says you're not, right?
Okay.
But what our job is right now is to deliver to our shareholders bulletproof work, right? So that means that the geological, the engineering, the regulatory, the stakeholder is beyond reproach, so that when we have to build a mine, we don't have to go back and do things again and again and again. And we see that happen a lot. Or if somebody wants to consolidate, they can come in and they can say, okay, this work is really good. I have a high level of confidence in it, and I don't need to go back and redo it again. And so for us, it's about doing it right the first time, no matter what the outcome. And that's our focus. And that shows the professionalism of the team and the professionals that Troilus has as well. But, to your point, Goldfields losing Yamana, well, their shareholders love that. $300 million break fee. Goldfields came out and made a public comment right away that North America is still where they want to be. So there's less fish in the pond to look at. You need size and scale. The majors were all looking at the Goldfields deal with Yamana. And I would say, and I know that all the bankers in North America and all the corporate development teams here and in Australia and elsewhere have been focused on upending that deal, looking for an entrance. And the Agnico guys did an unbelievable job timing a market perfectly to interrupt that deal. But they're all done now. And I would say that everybody's back. And so now that the big deal has closed, I think you're going to see consolidation fast and furious, because a bunch of things haven't changed. Look at Barrick's balance sheet. Barrick's balance sheet is the best it's been in 25 years. Ounces aren't getting replaced. And there's still a thirst for growth. And those who are in production today with the sunk costs, at $1,700 gold are making unbelievable margins still. Even though inflation's squeezing it, they're still making money. And so in that standpoint, I think you're going to still see a very active, jurisdictionally focused M&A market.
Okay.
I think it'll be slow through Christmas, and then the game starts again.
I agree with you entirely on that one, for sure. And that's why I've been kind of keen to understand, like, some of the moves that you're making to try to say, look, we're doing things differently, we're doing things smarter. We will get to. I will be able to create something that is attractive. So I want you to swap CEO hat and put your analyst hat on. Okay, 65 million in cash, 120 million market cap. With the answers that you've got, with the change in strategy that you've made, how discounted is the stock compared to where it needs to be?
Well, in the last 2 days, we've changed it, that narrative, right? Taking my Troilus hat off, if I am any, and forget about majors looking to grow now, if I'm any mid-tier company looking to increase inventory, but maybe my balance sheet is a little bit shaky, and capital is incredibly hard to get, Troilus is the number one hostile takeover target right now on the street, for sure, right? Forget about the 8 to 10 million ounces of gold that we have and the high grade zones that we have in the 400 kilometers. Think about the 500 million in infrastructure that we have and have upgraded. Think about the balance sheets that's there. The kind of sum of the parts is a little bit ridiculous. I think it's a function of where the gold market is in general right now. And it's also a function of the low grade bulk tonnage capital intensity that Troilus and many like us are. So there has always been this, you don't need to own it now. because it's going to take time, or you don't need to own it now because Troilus is going to issue equity because they're going to need another $40 million to get to the finish line and long lead time items and everything else. We've eliminated a lot of those risks, I think.
Justin, good to catch up. Well done on getting the money in. Now it's a case of, so what's the timing on the feasibility? Sorry, I missed that.
It'll be the middle of next year, second half of next year, and a resource well before that. But the resource will not include this new drilling.